Welcome to the InterMarket Analysis video update. This is being prepared for Monday, January 9th, and I haven't done one of these videos in a little while, and a few things have changed, but the same basic dynamics that we battled with in 2022, we're still battling with right now. But there are some changes, and I'll go through and point those out in this particular video. What I like to start off with first is looking at the current valuation by looking backwards at the trailing 12 months earnings for where the S&P 500 is right now. What you see is a chart where the black line is the S&P 500. If we measure the PE ratio, which is the price to earnings ratio, if that is set at 20, which 20 and above in a textbook definition is considered to be expensive. If we have a PE ratio of 15, that's where stocks are considered to be fairly priced, not too expensive, not too cheap. And if we drop down to a PE ratio of 10, that's this green line here, that means that stocks are undervalued or considered cheap at that point. For the last number of years, this black line, which is the S&P 500, has been well above the red line. And for the most part, if you kind of take out 2020 with the whole COVID plunge and everything, the earnings have also been rising. And this has helped to not only see the indexes go higher, but it's also made the market pretty expensive. But as long as earnings were still going up, investors didn't mind paying more for stocks. If you see these lines over here now, in 2022, they've actually been coming down. That's because we're hitting difficult economic times and the earnings inside the S&P 500 are also falling. Now, one caution that I will tell you about this chart is this is based on the trailing 12 months. These are earnings reports that have already come out. They've been published. They're public information. The stock market itself tends to look at forward PE ratios. These are guesses or estimates as to what the earnings will be in the future, and those PE ratios can be quite a bit different. We look at this for more of a historical context because you see that a lot of the time when the market gets too far away or too far above, specifically this red line, that can usually lead to some pretty significant declines. Now, it doesn't mean they're going to happen overnight. The chart that you see here goes back all the way to 1980. So the market can be overextended or expensive for a long period of time. Down at the bottom, I have the trailing 12 months PE ratio, and this is the spread between the S&P 500 and this red line. You can see as we were coming down in 2022, this was coming back more in line with just being expensive instead of really expensive. And there have even been a few times when we've dropped below this line. Now, what we'll be watching for going forward is as these come down, as the earnings come down, and even the forward earnings come down, we'll want to see that will generally have a lot of pressure on stock prices as well. But this can take a lot of time to play itself out. So this is just something to be aware of. You don't always have to make decisions right away, but this is something that you want to keep an eye on to see, is the S&P, which is the best benchmark of the entire stock market, is it considered expensive, fairly valued, or cheap? We're just a little bit into the expensive category right now. This is another look at that same chart, and I've also marked this up with some historical events that have happened going all the way back to 1980. You can see where the S&P was and how the trailing 12 months earning and the PE ratio followed during that time. Like here in the dot-com boom and bust, we got way overextended to the upside, and then we saw a real drawdown. Well, we also saw a real contraction in the PE ratio as well. And then we have the housing crisis back in 2008, 2009, and then the big run up. Here's the COVID plunge. And then way over here on the right, this is where we're at currently. Another thing that I often post in these videos, but that's really not applicable right now, it's a thing called possible positive scenarios. And this is when we've been going down pretty hard, pretty fast, and the market kind of washes itself out and gives us a lot of extreme negative signals. At the time I record this, there's really nothing that is being generated at this time. We've been in a sideways trend for a lot of the month of December and now possibly going into January 2023. And so there's really no recent signals that have been generated. But I look at these every day. I usually cover them in the daily videos that I post. And if you're interested in that, just watch those videos. And as those signals are generated, I try to be real diligent to bring that up in the video. Another thing that we look at is growth versus value. Growth is when you have companies like Microsoft and Amazon and Google, the big companies that really move the indexes up, and this is where you want to buy low and sell high. Well, that works great when we're in a really strong bull market, but we haven't been in that now in 2022 and possibly going into 2023. And so value stocks, the stocks that tend to hold up better when we're hitting difficult times in the stock market, those tend to lead. And I have a number of charts to show you with value really outperforming growth, and it has been for most of 2022. To start off with that, first I look at just a pure growth index, and we can see this longer term moving average. That's a 200-day moving average, and the blue line is a 50-period moving average. When the blue line is below the red, and you're going to see this a lot in a lot of these charts, that means that we're in a downtrend. And if you look way over on the right, it just shows where growth is still in a downtrend. Now, this is growth all by itself. We also look at a chart of value all by itself, and you can see here's the red line, which is the 200-day moving average. And even though it ran into some difficult times, it has had what we call a golden cross and crossed over positive, and value is now really outperforming growth. Now, another way that we look at this is a number of charts where we have growth versus value, showing that growth is really underperforming. And then on the bottom, we have value versus growth, which shows that value is outperforming growth. And it doesn't mean that value stocks are necessarily going to go up. A lot of times that just means they'll hold up better and not go down as much as some of the growth stocks will. And then I have a number of charts to show you the ratios between them. Here is the growth against value, showing that growth is really underperforming and in a downtrend overall. Then this is an inverse of that same chart, showing how value has been outperforming growth. Here's another look using some ETFs, showing how growth has been underperforming and how value has been outperforming. And then we look at some indexes as well, just showing how really not too long after we entered 2022, we crossed over with a death cross here, and we've been in a downtrend ever since, and it's still showing a lot of weakness overall. We look at some other markets. These are the 30 biggest software companies in the US, and this is where a lot of growth comes from. If you were in this particular index back in 2020, you saw some really, really good returns. Well, we had a death cross in late spring, early summer, and we've been just going down ever since then. And actually the cross was back in 2021, and then we've been going down, and then we maybe are setting up some kind of a base here, but we're really not turning back positive yet with these big software companies. Another thing we look at is the CRB index, and this is a monthly chart. CRB is where we tend to measure inflation. When this is going up, generally inflation is more of a problem. Well, we can see where inflation has been coming down. Then at the bottom, we try to measure inflation against deflation. Inflation is when prices are going up. Deflation is when prices are going down. And overall, it shows that we're bouncing up a little bit with inflation, but we are seeing some deflationary pressures in the market currently. Another thing we look at, and this tries to measure inflation as well, it's a thing called the Baltic Dry Index. And this is what does it cost to ship dry products from point A to point B. The more it costs, the more they're going to have to charge for those products, and that eventually bleeds over into the prices that will be paid. Well, after really spiking up in late 2021 and into early 2022, it's been coming down, and this is also suggesting that inflation is still declining overall, just based on this index. We also look at the CRB index, the Commodity Research Bureau. Over here on the left-hand side, you see how this index is weighted, and we were in a really strong uptrend through 2021 and for a large part of 2022. But then we started to see some weakness, and then late summer into the fall, we saw a death cross here, and now even the CRB is in a downtrend. Corn is another thing. I don't have any moving averages or anything to show you on these particular charts. I just want you to see how the prices have really been fluctuating. Here's the price of aluminum after really going up. I guess I do have some moving averages here. We have now been in a downtrend as well. So that's more deflationary. And before you get all excited about deflation, that's actually worse than inflation, because that can bleed through the economy. You think of the Great Depression that we had, if you know much about history and what the country and the whole world went through in the 1930s, that's really not a very good thing. And we're starting to see some more deflationary type influences come into the market. So just want to keep an eye on those things. Heating oil, which you probably like this because it's been coming down a little bit. It really spiked up, but has fallen back recently. Gas, this is something that affects all of us. It really spiked up in the early part of the summer, but has since really been retreating. And so hopefully that means that you're paying less for gas than you were at that time. Natural gas as well has really been declining at the same time. Oil, which really spiked up, has also been coming down lately. Another thing that we're watching is diesel, because that's how trains and big trucks get things from point A to point B. It really rose up here throughout 2022, but it has since been declining. Wheat, which we need that for our bread products and so forth, it really spiked up, but has since been falling back. Another thing we look at is fertilizer, where it also spiked up and has been coming down. And that's a little more helpful in the inflationary scenario, because in order to produce good quality crops, you have to have fertilizer. And if the fertilizer costs a lot more, that means the products are going to cost a lot more. Another thing we watch is lumber, where it just went up really, really high back during the lockdown and then saw a massive decline. Then it started to go back up. And then in 2022, it spent most of the year going down, and it's still continuing that downtrend as we go into 2023. The dollar, which was really, really strong through the latter part of 2021 and most of 2022, has been seeing some weakness, and we're getting in danger of having a death cross here. Some people think that the dollar is going to continue to go down, and that might help stocks, because the stock market tends to like a weaker dollar, because then when they go through exchange rates and when they're doing their books, it makes it look like they have more dollars, even though the dollar is worth less than it was before. But other people think that we're going to hit some support in here somewhere and then be able to bounce back up. Looking at the euro against the dollar, for a while, the euro was really tanking and going down as the dollar was going up. They were having a lot of problems in the EU. Well, that's kind of reversed right now, where we're seeing renewed strength in the euro and weakness in the dollar. And then this looks at the Japanese yen. They have their own big problems in Japan that I won't go into a lot of detail now, but I'm keeping an eye on that. But there may be some problems that will develop into the future with what's going on in the Japanese economy. That's the top part of this chart. And then we have the euro that I just showed you. And then you can see the dollar down below, where it had been really going up and has since been falling back. The British pound to the US dollar, it really had some problems. There was some kind of crises that happened earlier in the year, back in October, where their prime minister had to resign after being in office for a short period of time. Of course, the Queen passing away late last summer, that really didn't affect their currency, but had been a lot of upheaval in Britain. Well, now that seems to be getting a little bit better, even though the British pound has been seeing some weakness. It's still in a downtrend overall, but if it continues to go up, it'll probably see a golden cross against the US dollar. Copper is another thing that we look at. When copper is going up, they call it Dr. Copper. What's the health of the economy? When copper is going up, that generally means the economy is doing quite well. When copper is going down, that means the economy is not doing so well. Well, after really going up through 2020 and into 2021, it topped out in 2022, took a really nasty fall, has been trying to recover, but it still hasn't experienced the golden cross yet. Then we look at copper to gold. Which one's performing better? When this is going up, that means copper is doing better. When this is going down, that means gold is doing better. And we have another chart to show the relationship between the two. It's a ratio. This is a longer term chart. Also on this chart is the 2-year yield, where most of the time, the green and the black line, they tend to not get very far apart from each other, even though they're on different axes. And then when there is a real spread between them, it looks like something's got to give. Are interest rates going to come down, or is the gold copper ratio going to go up? Because a lot of people get into gold for an inflationary hedge. And if we are going to be still dealing with inflation, you would probably see this ratio continue to go up. Or if things are starting to calm down, you might see the green line come down, but they're really far apart from each other and they tend to move in the same direction. But that's not what's been happening for most of 22 into 2023. Gold, even though it's showing some recovery, is still in an overall downtrend. It won't be in an uptrend until this blue line crosses above the red line. Silver, though, it did have a golden cross, or a silver cross, if you want, not too long ago. Even though it's really choppy, it's been giving us more of an upward trend lately. Looking at some indexes, the CRB index, which measures inflation against the S&P 500, this just shows that the CRB has been really outperforming the S&P, but we're seeing that start to change, and we're looking at a bearish death cross here in this ratio between the two, where the commodities had been doing really well. And it's not that the S&P is doing all that great, it's that commodities have really been going down lately. Then here's another ratio, the S&P to the CRB index, where the S&P had been really underperforming. Well, now it's starting to outperform the CRB index. NASDAQ 100, which are growth stocks. These are the 100 biggest stocks that make up the NASDAQ. The ratio of the NASDAQ 100 to the S&P 500 just shows that the NDX, or NASDAQ 100, has really been underperforming for quite some time now. It's well below the 200-day moving average, and it's even below the 50-period moving average. Some other stocks, we have mega cap. These are the big ones: the Apple, the Google, the Microsoft, the Amazon. They're big monster companies. Well, in 2020 and into 2021, they were just going to the moon. But we've been seeing a lot of trouble now, and they continue to be in an overall downtrend. The S&P 100, which are the 100 biggest stocks in the S&P 500, they continue to really underperform the rest of the S&P 500. And then small caps, which in a good, healthy environment, we want to see small caps doing well. They're kind of in a sideways uptrend here, where they've been outperforming the S&P 500, but it's not a real strong move at this point. Low volatility stocks. These are stocks, again, that tend to hold up better when the market is running into trouble. They're crossing over positive, and even though it's really choppy right here, they continue to be in an uptrend as they perform or outperform a lot of the growth stocks that are inside of the S&P 500. When we do a ratio of the low volatility stocks to the SPY, which is the ETF for the S&P 500, it just shows how the low volatility stocks have really outperformed the rest of the S&P 500. The Dow Jones Composite Average. This takes the Dow, the transports, and the utilities and crams them into one composite average. And it's kind of hard to tell here, but we're looking at getting a golden cross here. The Dow's been holding up pretty well. The transports and the utilities, it's really the Dow that's been strongest as of probably last fall, when it really started to outperform. But this could be positive for the market, because especially if we continue to go up from here, that will really help the overall environment. Another thing we look at is Dow theory. Dow is and I use this a little bit different, where I also include utilities. I just eyeball this. I'm looking at the Dow saying, okay, we're coming down, but it's still looking a little better. Here are the transports. Are we seeing a major divergence between them? Transports are underperforming a little bit. And then utilities, they're kind of holding up okay as well. So we're not seeing anything necessarily big right now when we apply it to Dow theory. FANG stocks, this is Facebook, Amazon, well, now they call it Meta or Facebook, Apple, Netflix, Google. There's a whole other one. They're probably going to have to change the name here soon. These are the big ones that a lot of investors really like to get into. Well, they've been in a downtrend for the last year, and they're continuing in a pretty solid downtrend. ARK is another thing. A lot of people put their real hopes into ARK, and it was really going up well. It got up to about 160. Well, right now it's down around 31. And it's been in a solid downtrend for quite some time and continues to be so now. Looking at bonds against stocks, because sometimes people want to get out of stocks and get into bonds. Well, the bonds are showing some improvement here, but they're still in an overall downtrend. But it does look like it could be improving. And if we see a little more upward thrust with bonds, that could produce an uptrend. This looks at world bonds, where we really got hit. Now, this is the price of bonds. As bond prices go up, interest rates go down, and vice versa. As this has been going down, that's when interest rates have been going up. We hit some kind of a bottom here and have been trying to bounce back up. We even went below the COVID low, but we're still in an overall downtrend, but we are seeing some improvement here. Then the stock to bond ratio on a monthly scale, where it just shows that stocks have outperformed on a monthly basis, but they are starting to come back down now. So we want to keep an eye on this. Then looking at some other bonds to stocks, this takes bonds first and then looks at stocks, showing how bonds have really been underperforming. And these are the shorter term maturities, the 7 to 10 year, instead of the 30 year and the 20 year. But the 10 year is kind of the benchmark for the US economy. Then we look at the stock to bond correlation. How are they moving? Well, when this line is going up and the closer it gets to +1, that means that stocks and bonds are going in the same direction. And that could be positive for the market, because as bonds go up, interest rates go down. As interest rates go down, that might give some support to stocks. Then looking at the yield, now this is the interest rate attached to the 10 year, where it is coming down, but we're still at a higher level than where we've been for quite some time now. Also, some folks decide to get into corporate bonds instead of treasury bonds that are sold by the government. It is showing a lot of improvement here, but we're not seeing a golden cross as of yet. And here's the yield on the 10-year treasury bond, where it was up over 4.2%. Now we're down around the 3.559%. So interest rates have been coming down, but they've really been going up overall over the last year. This is the 30-year bond yield, also starting to come back down, but interest rates do still continue to climb. This is the S&P 500 to the 10-year yield. So it's comparing the S&P 500 stocks to interest rates. And this shows that the S&P has really been underperforming the rise in the 10-year yield on the bond interest rate. Junk bonds, these are higher, well, they're higher risky bonds, but they tend to give you a better return. And this tends to also follow more closely to the stock market, where they're still in an overall downtrend, but we are seeing some improvements. When we compare junk bonds to government bonds, junk bonds are more risky. Government bonds are considered very safe. And both of them have not really performed all that well in 2022. But junk bonds have been outperforming government bonds. So a lot of people like to get into that. Even though it's more risky, they like getting a better rate of return. This is a daily chart of interest rates, where we have a lot of inverted yield curves right now, which suggests that there's some weakness looking ahead into the economy. And overall, interest rates were really going up, but recently we've been seeing them come down. But this is really kind of crazy right now. Like this bottom one here, this is a 3-month. It's giving you a higher rate of return than the 10-year. So, I mean, it's just really inverted these days. And this is looking internationally, where we're mainly looking at the US, the UK, and Germany, where their interest rates have really been going up. And Japan's kind of in a category all by itself. Even though their rates are going up, they've got some other problems that may develop in the future. So I'm keeping a close eye on that one. Looking at some of the sectors, another thing that we watch for, and this can be one of our positive setups, is when we're coming down here, meaning that the S&P has been underperforming utilities, and then we hit a bottom and start to go up. A lot of times, if you look at the chart up above, that marked a low in the S&P. Also, when this is going up and we spike going up and then start to come down, a lot of times that will mark a top in the S&P. Well, right now, we've just kind of been meandering all over the place. So since this is going down, that's not giving us a potential positive setup. The staples, these are the things that you have to get no matter what's going on in the economy. They turned negative for a while, but now they've been able to cross back over positive. And this usually plays out against the discretionary. Staples are the things that you have to have. Discretionary are the things you would like to have. And that second car, that gym membership, that new home entertainment system, those are the first things to go. Those are discretionary when things start getting more difficult, but people still need soap and toilet paper and shampoo and things like that. So these tend to perform better during difficult times. When we look at the energy sector to the S&P, where the energy sector had really been underperforming, but it was the monster place to be in 2021. It started to look better. It really took off in 2022, and it's still in a pretty strong uptrend going into 2023. The tech sector, which this is where a lot of your growth comes from, your Apple, your Microsoft, your Google, because these are high tech stocks, well, they're still in an overall downtrend currently. And semiconductors, which is a big part of the tech sector, they continue to be in a downtrend as well. And then the tech sector against the S&P, this just shows how tech has really been underperforming the rest of the S&P 500. And some other areas that we look at, growth, ETFs against bond ETFs, they both have really struggled in 2022 going into 2023. So they're really starting to underperform, even though we have kind of an upward, this is an uptrend right now, but the longer we stay underneath this, the more likely it is that we're going to cross below these. So being in growth stocks and being in bonds has not been a good play over the last year. The 10-year treasury yield to the tech sector just shows that interest rates have been rising a lot faster than tech, because tech has been going down as interest rates have been going up. And this is an inverse of that same chart, showing how the tech sector has really been underperforming the rise in interest rates. Discretionary, again, the things that you would like to have really been underperforming staples, the things that you have to have. And that's the same, where staples have been outperforming discretionary. And energy to tech. These are two big areas where energy has really been outperforming as tech has been weak over the last year. Then we look at gold. Gold is starting to outperform the S&P 500. So we're kind of chopping back and forth here, but it's kind of a recent golden cross on the ratio. And then we measure gold against the dollar, where gold had really been underperforming the dollar, where now we're starting to see it bounce back. High leverage loans. These are risky loans that people are willing to take, where you generally pay a higher interest if you're going to take out a loan. But when these really start to underperform, that means that people can't pay these loans back, and that might be a harbinger of difficulties in the economy. Well, so far, this has really been holding up and actually advancing, and we have a recent golden cross here. Then intermarket analysis, and I've taken this back all the way to the beginning of 2022, because we've only had, 4 trading days now in 2023, where oil has been the best performer. And it was up well over almost 67% or so. Now it's down, or it's up maybe 18. Let's see. Yes, 17.5%. The other best performing asset has been the dollar. Gold, which spent most of the 2022 being negative, is now starting to go positive. Stocks have really underperformed and bonds have really underperformed. And then as we get deeper into the year, I'll redraw this chart to make it go back to the beginning of 2023. To compare some indexes, we take the American Stock Exchange, the NASDAQ, and the NYSE. We look at all the highs and lows across all three of those markets and then take a 5-day average of that. Sometimes this can give us a possible positive setup after we get an extreme negative reading. Well, we did get one and it helped us have a little bit of a bounce, but it fizzled out. Another way that we look at this is when this is climbing above this blue line, that means we're more positive. That means that the new highs are winning out against the new lows, but it's not very far above this level. So it does, but it is showing some improvement. Small caps, there could be getting close to a golden cross, but they're still in a downtrend as of right now. Mid caps, this did register a golden cross not too long ago. We actually climbed above this pivot. This is on the chart for the month. When we're above this pivot line, that's more positive. When we drop below it, that's negative. So this is some potential positive things that we're seeing when the mid caps start performing well. It'd be a lot better if the small caps would also start to perform better. The Dow, which has really been performing the best going back to last fall, it had a golden cross even further back. And so far, we've been staying above this 50-period moving average, and we're well above the 200-period moving average, and we closed above the pivot for the month. And I've been showing these charts, the mid caps and the Dow, in the daily videos that I do, just to give people some hope that maybe that will bleed over into the S&P 500, or if this really starts to break down, we might see that breakdown occur in the S&P itself. The NASDAQ is still in a lot of trouble and is still in an overall downtrend, as is the NASDAQ 100 and the Wilshire. This is a broad look at stocks where we're still in an overall downtrend. And you can see how we've been going sideways now for the last couple of weeks. All stocks, not only looking in the US, but also internationally, we are showing some improvement. We're coming back up to this 200-day moving average, but we're still in an overall downtrend. We need this to get above this red line and stay above it for this to produce a golden cross, but it hasn't done that yet. Emerging markets, some investors really like to diversify and get into other markets. And even though we're seeing some improvement here, we're still in an overall downtrend. The moving averages have not crossed yet. Then another international look, this just shows, and this is using the KST, which is one of the oscillators that we use. China's in a downtrend, the emerging markets, Europe, Japan, the US, all of these indicators are currently going down according to the No Sure Thing, or KST oscillator. Bitcoin, just been chopping sideways. It's been in between 16,000 and 17,000 now. Well, it kind of entered that back in November, and it bumped up to the 18 levels there for a while, but it's with all the other things that are going on in the whole cryptocurrency universe, Bitcoin is really losing a lot of love these days, especially after really spiking up at 68,000. Some correlations that we also keep an eye on. How's the S&P acting against the US dollar? They're having a tendency to go in opposite directions. As this correlation goes down, that means that they do move in opposite directions. And so as the dollar is going up or down, stocks are usually doing the opposite of that. Also with oil, we're seeing kind of a neutral relationship between the two, but oil is having a slight tendency to go in the opposite direction of stocks. The S&P to the 10-year yield also tending to go in opposite directions. If interest rates are up, generally stocks are down, and vice versa. And then the tech sector to interest rates, it's getting back more to a neutral reading right now, where for a while they were going in pretty solid opposite directions. The S&P to the 2-year yield, pretty close to the neutral line, but having a tendency to go in the opposite direction. So, and there's been some changes on this chart. For those of you that have been watching these, there are some positive things in the market. We have value indexes and ETFs, which just focus on value stocks rather than growth stocks. the US dollar, but it is weakening. If we see more downside, silver, which just had that recent golden cross, energy is still really outperforming a lot of the other markets and is still in an overall uptrend. Interest rates are kind of mixed, but they tend to be going up overall. High leverage loans that I pointed out, they're looking fairly positive, and staples, the things that you have to have. So a lot of these things that you see on this list are more defensive in nature. We also have the Dow. Now that's more stock oriented. That's more of a blue chip index, and to have that turn positive is kind of heartening. Mid caps also had a recent golden cross, and then the low volatility stocks inside the S&P 500, and there is an ETF that is attached to that. And then the Dow Jones Composite Average, which takes the Dow, the trannies, and the utilities together. They're looking more positive. For the longest time, there were about 3 things on this list. Now that's been able to be expanded. Now on the negative side, the Dynamic Software Intellidex Index, those are the 30 biggest software companies. The CRB Index, which are commodities. The world indexes are still down. Junk bonds, even though that might be changing here with junk bonds pretty soon. FANG stocks are down. Small caps are still improving, but still in a downtrend. The NASDAQ 100, the mega cap growth ETF that I showed you, that's still in a downtrend. The NYSE composite, all stocks, which look at all stocks both in the US and worldwide. ARK, which is just having all kinds of trouble. Bitcoin, the Wilshire, which is a broad market index. Treasury and corporate bond prices. That's not interest rates, these are prices. So they're still showing some weakness. Gold, which if it keeps going up, it might have a golden cross. And the tech sector, as well as semiconductors. So thank you. I hope you found this useful. I usually do this video once a week. I hadn't done it in quite a while for personal reasons. I've been battling an inner ear infection, and it just prevented me from doing these. But my plan now is every Monday for Monday's session to do an intermarket analysis video. So have a great week, and I will talk to you in the next video.